Look, we blew through 2000, never challenged it. Blew through 3000, never challenged it. Blew through 4000, still haven't challenged it. We may, but as we said, support a step back in. But when you follow the narrative, the conventional wisdom of the mainstream, and some of what they say is legit based upon what I just said, and blowing through these averages, 50, 70, $100 a day moves, that's unprecedented to the upside. But when we look at what happened in the middle of the evening last night, where in the thinnest part of the trading cycle, when New York is fast asleep, someone or some entity or a coordinated effort dumped a massive wave of futures contract onto the market. Again, when New York was fast asleep, this drove silver under $50. It knocked gold down $100. But then something interesting happened. I mean, this was shock and awe, Michelle. This is a drive-by shooting, right? Any trader that would be stupid enough to dump that level of futures onto the market at the thinnest trading segment of the day, when there's virtually no liquidity, would be fired and shot, and probably not in that order. And it was specifically done for effect. But what was interesting is that we saw players come in almost immediately right after this happened and push the price right back up. Now, is that physical buying? Is it knocking down the paper price and coming in and buying the physical to cover the shorts? Maybe. We don't know who it is. We have an idea. Watching or reading Michael Lynch gives us a good idea, a little bit of a snapshot. He comes out and says straight out that this was an engineered crushing by the paper shorts. They're behind it, behind the scenes. But someone came in and snapped up at a record pace. He thinks it's Bank of America and Morgan Stanley. Bank of America last week raised their target on silver to over $66 or $67 for next year, with an interim price, medium price between now and then, or an average price of somewhere around 57. He goes on to talk about that since October 17th, 6,000 new immediate delivery contracts were written, which is all but a record for this late stage of the delivery cycle. And he goes on to say, if the pace continues, it could be one of the biggest delivery months ever on record, challenging the February and March deliveries. So in other words, the market got bombed by paper in the middle of the night when no one is trading and New York is asleep, which provides all the liquidity. But yet someone came in and gobbled a whole bunch up. And at the same time, we saw 11,000 paper long contracts closed out. So this is a very unusual drive-by shooting for effect type of sell-off. Yet some of the fundamentals that are cited by the mainstream are true. It's a half-truth. Yeah, those things are true, and the markets can stay overbought for a long period of time. But to ignore how the sell-off occurred and just simply say this is profit-taking is ridiculous. It's just not good reporting is what it is, because any normal trader would have spread that out during the most liquid time of the day in New York trading over hours or even days to maximize that level of return, not dump it on for effect. And that's exactly what happened. And I think that is something that should be taken into consideration as we continue to talk about what's going on. Bank of America and Morgan Stanley, which had been dormant for a long time, or actually net sellers, flipped from selling. And he believes that they are two of the largest purchasers that came in and snapped this up. Now, a lot of this is he has a way of figuring it out. But the bottom line is, I think what we take away from this is that there were some big players who scooped up. And is it scooping up physical to cover short positions below 50, below moving averages, or at least below trend lines? And I think that's actually possible, because what we see is the buying of, in the last 3 days, by Morgan Stanley, 196,200 ounces, by his estimation, in the last 3 days of gold. So, when you talk about knocking the paper price down to create the lowest or worst possible settlement to drive the price down, and then buyers coming in to scoop up, I mean, that just reeks of coordination, of suppression, of a ulterior motive, rather than doing it the way any normal person would do, and that would be to slowly sell your position to maximize the return. instead of the antithesis, what we saw. A lot of people have been talking about, myself included, what's been going on in London. Large quantities of silver are being transported out from exchange warehouses and sent to secondary silver vaults across the country, ensuring the daily silver needs of millions of industrial enterprises. At the same time, state-owned enterprises are taking advantage of the significant price pullback to actively purchase silver from international markets, ensuring the normal operation of the industrial system. China is intensifying reserves of various strategic resources and will absolutely not allow key mineral resources to flow out of the country, nor will ever compromise national interests to rescue a foreign company. Now, here's another thing. Eric Young, King Kong on Twitter, that I've been wanting to have you interview. I've interviewed him once before, and he's fantastic. He says, I was just told that 150-ton lease, or 4.82 million ounces, actually was leased by the London Metals Exchange from the Shanghai Metals market, and that it was done so at grotesquely high lease rates for a very large tonnage. This would signal that borrowers who are short of deliverable metal and are willing to pay up to bridge the near-term needs in London are doing it because things are of that dire of a situation where it could really start to spiral and contagion can take effect. So again, when you see someone at this level who's been right for a very long time, and I have nothing but the highest amount of respect for him, to me, the bottom line is that the theme that we've been talking about, the tight physical, the high lease rates, the cross-region scouring for bars, this is real and well reported. And if you see 150 million tons from Chinese state banks and via the Shanghai Gold Exchange delivered to London to quell this problem, it would go hand in hand with knocking the hell out of the price by the same players to make people think the market is overvalued, that it's at its peak like it was in 1980 and 2011. And look, letting the price go up as high as it did pulled in an awful lot of speculators, and a lot of them didn't own gold; they just owned paper. And so when you dump massive waves of futures contracts into this thinly traded market, a lot of them sold without even knowing. They got triggered out of their contracts, which drove the paper price down. And maybe that's when you had London come in and say, we need to buy this silver at a lower price. Maybe it was London who came in and bought that silver after they knocked it down. I don't know who did it and who bought it. But I do know is that, to me, the whole point was to scare people away from buying gold and silver. That's what it really feels like to me. And this wasn't just another random correction. To me, it's as much as it could be as big as helping keep the LBMA propped up to maintain their system. But if there really is that much of a shortage that we've been hearing about forever, this game can't last, and supplies will keep shrinking no matter what amount of paper selling comes into the market at inopportune hours. And so I think, again, yes, it's scary to see a market move like this, but the fact that it moved like this is what, to me, makes it not so scary. It just reeks of desperation by big players who have been caught in a game where no one ever stood for delivery, and a continual rotation of paper promises has been what has allowed the fixing of gold and silver by the West forever. And it is now being challenged. Not just gold and silver, all of the world's commodities are being bought. And when we see 21 days of backwardation, where the normal market is called contango, where the price is for the future, or the spot contract is lower than the futures contract. When you go out into time, you have the cost of storage and interest and the time value cost of money. That's normal market. Backwardation says, I don't really want to trust you next month or the month after. I want it now, and I'm actually going to pay more for it right here today than I will out into the future because I really don't trust the future. And to see that in silver is really unusual. And for as long as we did, and as much as $3, now it's narrowed. But what I'm saying is that is really very bullish. And when you see this kind of desperation, knock the hell out of the price and then gobble silver up to where it goes green in 20 minutes, someone came in and bought physical, and maybe that was the trade. Maybe what Eric Young is saying happened right then and there, that China leased the gold at that level, sold the gold to London to bridge the gap at a huge rate of borrowing. I don't know, but all I can tell you is that it is not what one would expect to see in a normal market behavior, not even close to it, unless you want to be guaranteed the worst possible settlement for your, huge trade that you dump just like that at the worst possible time. Michael Lynch says Barclays sold 1,969 contracts, RBC customers 1,076, and Scotia House account 2,024. And, could it be profit taking from earlier buys? Maybe. But at 100 ounces a piece, when you're talking 2, 3, 5,000, 6,000 contracts, that's an awful lot of gold being dumped. We don't know who and why they would do it specifically, but he is saying it's the banks that are not the U.S. banks, Barclays, RBC, and Scotia. There are a lot of people that sold into this rally who would have probably hoped into this drubbing, that probably hoped they never would have had to have those stops triggered. But I think that's what happened in the middle of the night when you saw such a massive drop at a period of time when there was no liquidity, which just dropped the price. And then all of the triggers that would then automatically hit to sell to protect these funds from getting killed would only add to the drop. And then you had the value buyers come in and push it right back up. I think that from a standpoint of where it is ultimately going, I think it's going to continue to go higher. The bull wants to take as few people along for the ride as possible, Michelle, that I do believe. And so, I think that ultimately the markets will have their way. But again, you have a lot of very big players who are on the wrong side of this, massively short. Eric Young is saying that the LBMA reached out to China and said, we'll take it at these obscene rates. We need it now. We need it. And we'll pay the high lease rates because of that. Because when you play a game, and look, it's not just silver collapsing. If there was a major delivery failure by one of these banks in London, as an example, all of these banks are not just involved in bullion. They're involved in every single asset that could be traded across the globe. The systemic contagion of this would be catastrophic. It would bring down some of the biggest banks in the world. And this starts to move towards what Tom Luongo talks about, on a coordinated attack against the Bank of England and the European aristocrats. And I don't know that to be true. Tom believes it. But all I can simply tell you is that the fact that it was done the way that it is done, and then you had someone come in and scoop things up, pushing silver right back up into the positive territory, tells me it was coordinated. It was coordinated by players, perhaps, to drive the paper price down, to accumulate physical at much lower rates to make good on short contracts that were getting very close to creating this huge squeeze that everyone has been waiting for forever.